Term life insurance is insurance that provides a lump sum amount to your beneficiary if you die. The word term in term life insurance means the insurance policy terminates. The policy only covers you for a year or a few years. This is the way all so-called pure insurance works. Your auto insurance usually has a term of a year. There is permanent homeowners insurance in Pennsylvania, where it was invented by Ben Franklin, but it is quite rare elsewhere. If you still want life insurance coverage after the policy terminates or expires, you have to buy a new policy, and almost always at a higher price because as you age, your chance of dying increases. In general, for people without special needs, the need for pure life insurance is a short-term need during the period in which they have dependent children. The purpose of life insurance is to protect your dependents from financial catastrophe in case you die. Low-cost term life insurance that is not renewed once the children are gone is usually the best option. The purpose is to provide an amount of money in the event of your death so that your family can maintain their lifestyle and attain financial goals such as financing a college education. Term insurance, like all pure insurance, only lasts for the policy term and then lapses if not renewed. The cost of term insurance goes up every time you renew, even if you keep in good health, because the number of deaths goes up as the people in the pool gets older and their mortality rate goes up. There is such a thing as permanent life insurance that does not require renewal, but really the only meaningful difference between permanent and renewable term life insurance is the fact that permanent life insurance policies provide for a level premium that is too high initially for the insurance cost, and the difference is put into a fund, which is called the cash value account, that is used to offset the higher premiums in later years. There are two variants of permanent life insurance, whole life and universal life. The twist offered by universal life is a higher interest rate on the cash value, which may allow for lower premiums later on, plus an option to have the death benefit increased by any excess cash value in the account at death, which is called option B. The level premiums and the cash value of permanent life insurance may seem an attractive alternative to term life insurance, but you can do better financially if you have the discipline to buy a renewable term life insurance policy, plus an index fund or even a money market fund with a premium difference in the early years. And anyway, most people shouldn't get permanent life insurance at all, because the need isn't permanent. The point to remember, the point to stress, is that most people have no reason to own life insurance after their children have become independent. Life insurance is not something that most people should own for life. The need for it goes away at around the time that the premium starts to ramp up. Of all the pure insurance types, term life insurance is often the least well understood. Not because term life insurance per se is particularly difficult to understand, but because it's life insurance. For centuries, there was only term life insurance. That's all there was. And then in the mid-1970s, largely because of favorable tax treatment, the product began an explosive transformation that continues to this day, creating a myriad of heavily marketed investment products in which the insurance component is largely incidental. Let me say that again. Life insurance that is sold as an investment actually tries to minimize the insurance part. The insurance is incidental. The only advantage, if any, of these products is their tax advantages, which is a legislative issue created by insurance industry lobbyists and has absolutely nothing at all to do with insurance. But the pure insurance of term life remains a valuable tool for personal financial planning, and the price of term life insurance has been driven down dramatically through the pressure of information and competition brought on by the Internet, primarily, and to a lesser extent because of increased longevity. This graph shows how term life insurance rates have fallen as a result of the Internet and also as a result of the fact that people are living longer. 3 years longer for every decade since the Second World War in America. The amounts represent the cost per $1,000 of coverage at different ages. The data is drawn from the IRS, which uses it to impute income to people who receive life insurance from their employers. The top dashed line was valid from 1955 to 2001. Essentially, life insurance rates didn't change for 46 years. By 2001, however, rates had been driven down dramatically, as you can see by the lower red line, in some cases by over 75%. This chart simply carries on the data out from age 51 to 100. What is most telling about this chart is that in 1955, rates were not quoted beyond age 81, whereas by 2001, the chart was carried out to age 100. These charts should not be used to estimate your own actual policy cost. You can go online to 100 sites to do that, and life insurance agents will be happy to talk to you if you are young and healthy or old and rich. But the charts are representative, and they do illustrate A, the fact that the cost of life insurance rises as you get older, B, prices have fallen dramatically, and C, they show the population's increasing longevity. From the standpoint of the opportunity cost of the insurance policy premiums, the best deal for term life insurance is a single premium policy with a term equal to the period of need. In other words, one 20-year term policy if you expect to need life insurance for 20 years, rather than two 10-year term policies or four 5-year term policies. Single premium term policies are unusual, and the next lowest opportunity cost option is a level premium policy. What this means, first of all, is buy a policy that covers the entire period that you will need it. And second, pay the premium all up front if you can find such a policy. If not, then the next best is a policy for which the premium charged is the same every year for the entire term. The second choice is called level premium.